Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. It's February 11th, 2009, when I'm taping this, and my guest today is Todd Zywicki, professor of law at George Mason University. Todd, welcome to EconTalk.
Great to be here, Russ.
Our topic today is debt. A lot of people argue that our prosperity in America is an illusion. We've built our standard of living on debt. Obviously, we've had a lot of problems in the housing market recently related to debts that didn't get repaid. Is there any truth to this worry that somehow our standard of living is built on a house of cards and living beyond our means, et cetera?
Well, certainly what we've seen over the past few years is that in the housing market was at an unrealistic level of debt, and that bubble is bursting. But the more systematic question, what people usually have in mind, is the idea that the consumers have too much consumer debt, too much credit card debt, and that sort of thing. Well, if you look back over the course of history, this theme, this paranoia in some sense, that the sky is falling because there's too much consumer debt, that's almost as old as America itself. In 1873, the New York Times expressed the concern that Americans were running in debt. And by 1877, the New York Times already was concerned that Americans were borrowing trouble. They were concerned in the 19th century. They were concerned in the 1910s. They were concerned in the 1940s. In 1940, Harper's Magazine asked whether debt is threatening democracy. And so what we've seen is, as long as we've had debt, we've had a lot people who were concerned that other people had too much debt.
Of course, you and I have the right amount, right?
Well, of course.
Yeah. I think it's an interesting question. We have, I suspect, a lot of emotional baggage about debt and indebtedness and fear of the poorhouse, which in the old days, or debtor's prison, which is the way society dealt with folks who live beyond their means. Somebody said to me the other day that obviously what we've learned from this crisis that we're in the middle of is that debt's bad. And I think a lot of people, we swing, right. We have this sort of overcompensation. When credit is easy, we tend to some people borrow too much. And now that we've seen the consequences of that, we tend to say, I'm never going to go into debt again. And is there some pendulum aspect to this?
Well, there's a couple interesting things in what you mentioned, which is first, we do have a schizophrenic view towards debt. The way we think of it in some sense is that credit is good and debt is bad, right? Even though they're the same thing. We recognize that credit is something that empowers people to be able to start businesses and make their lives easier. But we also recognize that there's a fear, and there's no doubt that even though I expressed the opinion that this idea that the sky is falling is a recurrent one, there's no doubt that as long as we've had debt, we've had people who have not been able to manage their debt very well. That's always been with us, and it's still with us today. But I don't think there's any evidence to suggest that it's that much more of a problem today than it was in the past. And in fact, with financial innovations and the growth of consumer choice, I think, if anything, consumers have much more power now. They're much more empowered when it comes to dealing with debt and dealing with credit than they were, say, 50 years ago, when your only source of credit was your local banker, who could basically charge you whatever he wanted to before he would give you a loan.
Because there wasn't a lot of competition in the banking business. There was a lot of restrictions on who could open a bank, how banks got started. Couldn't operate banks across state lines, right, for a lot of time.
Exactly. And what we've seen over the last 2 or 3 decades is this great proliferation of consumer choice. If you think about it, say 30 years ago, 40 years ago, if you wanted to buy a new refrigerator, what would you do? You would go down to the local appliance store, you'd open up a line of credit, and you'd pay it off in monthly installments, $50 a month over 2 or 3 years or something like that, right? What they would do was probably charge you 30 or 40% interest, but they just bury it in the price of the refrigerator, so you might not even know you were paying it, but you basically had to get the credit with the refrigerator. If your transmission blew out and you needed all of a sudden to get a car repair, you'd have to go down to the local personal finance company and borrow $3,000 as an installment installment credit transaction where you would repay it, say, $150 a month over 48 months. What we've seen since then is
these are people who don't have enough cash.
Exactly, right. But
some people paid cash, presumably.
Exactly. Some people paid some cash. But if your car was broken and you needed your car to get to work, you were going to borrow in order to do it. People would use pawn shops. People would have to borrow from friends and family. There was all kinds of mechanisms people used to make ends meet 40 or 50 years ago. Now,
and we're talking about items, of course, that have a long life. So it would be reasonable, given the refrigerator might last 5-10 years, that you wouldn't want to pay all the cost up front if you were cash constrained.
Exactly.
So I think one of the issues that people forget is that when they rail against debt is that it's rational to use debt to finance purchases that are long-lived, that are capital goods, durables.
Exactly. And if everybody knows that Henry Ford invented the automobile in the 1930s, sort of, right? But already by the 1940s, General Motors had eclipsed Ford as the largest motor company in America. Do you know why? Basically because General Motors was willing to sell cars to people on credit, or Henry Ford believed that people couldn't be trusted to buy a car on credit, and that the proper way to buy a car was to save up enough before you could get a car. Well, it seems like it's a lot more useful to have a car to drive yourself to work, to make money to pay off the debt, rather than have to walk or take the bus to work until you can save up enough money to buy a car to drive yourself to work.
Because it's a large capital purchase.
Exactly. And very quickly, General Motors replaced Ford as the number one automaker in America, and that's been the circumstance ever since. But that was the driving factor.
Now, other people who are more alarmed about the trend in debt point to rising debt as you say the sky is falling. They point to rising debt as a measure of that we're living beyond our means. What's your take on those claims?
Well, as I suggested earlier, 40 or 50 years ago, consumers were making all kinds of uses of debt. They were furnishing their houses with installment loans from furniture stores. They were buying appliances on time. They were buying cars on time. They were buying pianos on time.
On time meaning that they paid a monthly payment.
A monthly payment, what we call an installment loan. Basically, what we've seen since then is the credit cards have simply substituted for a lot of those old transactions. I was stunned. I'll admit, when I first started on this research project, I was expecting to find what the conventional wisdom was, is that Americans are out of control and overwhelmed by debt, and that they just can't control themselves. If you look at the actual data, though, in a way, the best ways of measuring it, what you see is that the effect when it comes to consumer debt, all this growth in credit card debt, which is huge, there's no doubt about it. We've got an amazing amount of credit card debt, has come 100% as a substitution from those other forms of consumer credit. So no longer do you buy a refrigerator by paying $50 a month. You put it on your credit card and you pay it off. No longer
you pay the credit card company $40 a month, right? Because it's a lower rate of interest.
It's a lower rate of interest, exactly. No, and no longer, if you have a car repair, do you go down to the personal finance company and have to borrow $4,000 and pay it all off at once, because the cost of underwriting the loan, you have to borrow more than you might need. Put it on your credit card, pay it off when you get back to work. And so what we've seen is the growth in credit card credit has been a substitution from all these other motley forms of credit the consumers have had in the past. And the reason why they've done it is because although you think of credit cards as being expensive forms of credit, they really are much less expensive than a loan from a loan that you got when you bought a refrigerator, or a personal finance company loan, or whatever. And it has the additional benefit of unhooking the credit transaction from the goods transaction, which not only allows you to force the lenders to compete on the lending transaction, you can go online and you can buy on Amazon, or you can buy somewhere else. You can make the sellers compete
price,
on the product price, right? You unhook those two things, and so consumers get a better deal with the product and a better deal with the credit.
Well, it's more transparent, and it also allows specialization. People are better at keeping track of loans, specialize in that, drive down through competition. We hope the margin on the interest rate, and similarly, people are good at making refrigerators and cars compete on making them cheaper and
exactly.
pass on the savings.
And one of the unacknowledged but unfortunate things about the credit freeze is, unfortunately, we're seeing a rolling back of the clock, which is one of the. It used to be what one device that a lot of people, especially lower income people, would use was a layaway plan. And as we were discussing earlier,
explain what that is.
A layaway plan.
If you're under the age of, I don't know what it is, 40 probably, you might have heard of it,
right?
But it was common in the old days.
Right. Basically, on a layaway plan, you would pay for the goods in installment payments before you could get it, right?
And they'd lay it away for you. They put it on the shelf and say, "This one's yours.
This one's yours, and you have to pay us, $20 a month. And if you make all those payments, at the end of the time, you can get it, right? It was basically Henry Ford's model of how you had to buy a car, which is you would buy a layaway.
They kept track of the savings.
They kept track of it. We've gotten rid of layaway. Why? Because people would rather have the goods,
strangely enough,
so they can use it rather than having to pay for it in installments first. So we got rid of layaway plans.
And we got they always wanted to have the good first, but the reason we got rid of it was because the innovation of credit cards.
Because the innovation of credit cards empowered those lower income consumers who were forced to rely on layaway in the past now could get access to credit cards on a very competitive basis. Reports came out this fall that companies like Sears, Kmart, during the Christmas season this past fall, were bringing back layaway. Why? Because the credit crunch meant that consumers were unable to get access to credit cards. They were unable to use their credit cards, and so we brought back layaway. We've seen reports that the credit crunch has caused middle-income consumers to start using pawn shops again because they are, in small business people are using pawn shops because they can't get access to unsecured credit and credit cards on a competitive basis. We've seen reports that middle-class people are using payday lenders because lenders are afraid to extend credit to people. That's the real cost. When you come in and you start saying people have too much credit card credit, or you're concerned about how people are using credit cards, some people will end up going without credit. But what a lot of people are going to end up doing is having much less attractive forms of credit. They're going to be forced into pawn shops, layaway plans, payday lenders, personal finance lenders, and even Tony Soprano is willing to offer you some credit if you can't get it anywhere else. And so what we should recognize is the way in which access to credit cards and credit on that sort of way has been an empowering opportunity for people. And the way it's been empowering is by giving them this choice as opposed to all those other choices that they used to be limited to.
Now, some people would argue in the old days, I would get 2 or 3 offers of a credit card in the mail every day. Mm-hmm. I haven't gotten many of those lately, I've noticed. They seem to have dropped off, which is this phenomenon you're talking about, that consumer credit markets are struggling. Talk about how we know that's true and what perspective people have on credit card companies. I mean, a lot of people think that credit card companies are predatory, that they send you this envelope with this teaser opportunity, this wonderful, sometimes you get frequent flyer miles up front, and the next thing you know, you're deep in debt. And so I think a lot of people view the issuers of credit as a negative. You're portraying it as a very positive. But first talk about this issue of credit card markets right now. A lot of things you read in the paper, occasionally at least, I find them very strange, but maybe of a different perspective, that when Paulson was Secretary of the Treasury, was worried about credit card markets freezing up, with the argument that these credit card loans used to be bundled together, akin to the mortgages that were being sold, and these securities are being issued backed by credit card loans to individuals. It seems like a good thing that we have less of that? It seems like we maybe had too much of that. Do you think we had too much of it? And then comment on the role of credit card companies.
Well, it's always been the case.
And sorry to interrupt. So these stories of payday loans coming back and pawn shops, are people losing their credit cards now? Are they just not using them? I mean, what do we know about what's actually going on? Or questions.
As long as right, there's a lot there, but as long as there has been credit, there have been people who've gotten into trouble with credit who and have gotten in over their heads. In the around the turn of the century, 1910s, 1920s, there were reports in New York City that the average person might have as many as 12 pawn shop tickets in their pocket during the winter when the mills were closed down because of water power and that sort of thing. And so there's always been people who've been living on the edge with credit, whether it's pawn shops, whether it's payday lenders today, or whatever the case may be. Multiple credit cards, absolutely. And there are certainly, and there's no doubt that credit card lenders, some credit card lenders have been, have not treated consumers very well, and that it's clear that the disclosures are not as always user-friendly as they should be. Whether that's because of regulation or some other reason is another question. But certainly it'd be nice if consumers could understand their credit cards better. Credit cards are certainly a much more complicated product now than they used to be, but that's for a reason. Credit cards in the 1970s were a very simple product. They were a simple product that had an 18% interest rate, a $40 annual fee, and didn't give you any benefits like frequent flyer miles or cash back or anything like that. Today, credit cards have a lot of different terms, but they also have lower interest rates, and you can look at the Federal Reserve if you don't believe that. The interest rates are lower. Annual fees have disappeared on credit cards. We've got this great proliferation of benefits for consumers. And so they've become more complicated, but they've become more complicated because of consumer demand more than anything else. And with complexity comes the possibility that some consumers are going to make a mistake. What we also know is that consumers, they make mistakes. There's no doubt about it. They get confused. But when you look at how consumers behave, they kind of figure out what's going on. So, for instance, if I were to ask you what the interest rate on your credit card is, or anybody listening to this, or a lot of people listening to this, my guess would be they'd have no idea.
I have no idea.
I have no idea. Why do we have no idea?
I usually pay mine on time.
So do I.
And it never, therefore, gets troublesome.
Right. And it's not even a factor, really, for you when you're deciding which credit card you want to carry, right? No. What you are aware of is how quickly you might accrue frequent flyer miles. You're aware of what the annual fee is, whether you get cash back, right? These are the kind of things that matter to you because you're what we call a transactional user of credit cards, where you pay off
the convenience.
For the convenience, and you pay it off every month, right? Well, it turns out that people who revolve on their credit cards from one month to another, what we call a revolver, they are very aware of what their interest rate is. And they shop very aggressively on what their interest rate is and shop for the best deal. So we know that the fundamentals make sense in the sense that credit cards are more complicated. That can cause people more confusion, but people have the incentives, and what we observe is that they actually act as we would expect, which is you shop on the margins that matter most to you.
I have to confess, Todd, that when I was younger, I was very aware of the interest rate. I was much less likely to pay it off
exactly
in my youth, so that there's a confession. Oh, so what about the world of today? Do you, I mean, this week, do you think do we have a problem in the credit card market? And is that what's causing the things that you're talking about, the return of layaway, or is that just simply people who've made errors and now are stuck and are finding alternatives?
From what I could tell, getting systematic data has not been easy, but all reports point to the idea that credit card lenders are tightening up. And we see two things that happen, which is, again, American consumers are often smarter than we give them credit for. They get some sense of what's going on. So what we see over time is that when the American economy starts slipping into a recession, consumers don't just walk like zombies right up to the cliff and fall off. What they do is they start planning for a recession, which is you start scaling back your purchases before you lose your job. You start saving more. You start throttling back, basically, right? So consumers are borrowing less, as we know, because they expect rough times ahead. So they're not just foolish sort of lemmings walking off a cliff. But we also know what seems to be the case is that credit card issuers and all lenders are aware that the economy is going soft also, that people are going to be losing their jobs. Well, when people lose their jobs, oftentimes they start drawing down credit lines more often. So what you have is a concern if you're a credit card issuer that somebody might lose their job and all of a sudden start borrowing more, right? So all of a sudden they've gone from being a very good risk who always pays their bill on time to a high risk because they've lost their job and they start revolving with no knowledge of how they're going to repay it. So everything indicates, and economic theory would suggest that creditors are probably scaling back. Whether that is a result of just anticipating slower economic times, the credit crunch, or both, I think it's difficult to tell.
One thing you haven't mentioned is home equity. There was an explosion in home equity lines of credit in the early part of this decade, 2000 and I'd say, 2 to 4, 3 to 5, around in there. Surely some of that was not well thought out, or at least was counting on some appreciation that didn't happen. But people were trying to live happily they were trying to consume some of the equity, the appreciation of their homes, and that disappeared. And so now we're in a little bit of a problem over it.
That's exactly right, which is what we know is that, again, consumers plan ahead to some extent in the long term as well, which is that if your wealth goes up, say either because stocks go up or the value of your house goes up, you're wealthier in the long run. Your listeners may be familiar with what is called the permanent income hypothesis, which is the idea.
I don't think we ever talked about it explicitly.
It's the idea that
Milton Friedman's idea.
It's Milton Friedman's idea. And basically the idea is that when you're planning your life, you try to sort of average out your consumption over the span of your life. And so you don't, if you're making $100,000 this year and only expect to have $20,000 a year when you're retiring, you don't spend all $100,000 now.
You don't live like a king now and live like a pauper later.
Exactly. You try to smooth out your consumption over your lifespan. So if your wealth goes up, if your stocks go up, or if your home goes up, that makes you wealthier in the future when you sell your home or you sell your stocks.
If they stay up.
If they stay up, exactly, yeah. Exactly. But what we know then is that people have expected that those would stay up, and especially homes, obviously. So what people did was, banking on the idea that their homes were going to be worth more in the future, in the indefinite future, they went out and they borrowed against that. And what we know from looking at the evidence, or what seems to be the case from looking at the evidence, is that when your home goes up in value, people in general tend to spend more of that. They spend as much as 6 to 8% of the appreciation of their homes today, either through home equity loans or borrowing against it with credit cards or whatever the case may be. For stocks and bonds, or financial assets, it's a lower percentage. It may only be 2, 3, 4% that people spend. So when the wealth increases in homes, more people become wealthy, but people also seem to sort of lay it out there a little bit more. Whether that's because they think that they've traditionally thought that increases in home prices were more permanent, or whether because homes are more widely held as a source of wealth among more people in society. In lower income people tend to have what we tend to consume more of that because to smooth their income versus their wealth. We don't know, but people draw down their wealth. But as you noted, it seems like they drew it down in an overzealous sort of way.
And the consequence of that, of course, is couple of things. The higher, it leads to problems that extend beyond just the issuers of those lines of credit, and obviously the issuers of those lines of credit also had the expectation that home prices were going to do pretty well, or they wouldn't have made the loans. It's important always to remember there's usually two sides of the transaction.
Exactly, and we could talk in more depth about foreclosures later, but this is undoubtedly a major contributor to the dramatic rise of foreclosures that we've seen, is people drawing down their equity or interest-only loans that cause them to not build up equity, and those factors.
Yeah, we'll get to that, but before we do, I want to talk about bankruptcy. Again, I'm fortunate enough not to have a lot of personal experience with bankruptcy law, and I'm sure some of our listeners are in that group. So I don't really understand how it works. I think most of us have a vague idea that you take out, a bunch of credit cards and you can't pay them back, either because you lose your job, you just get overextended, you make too many promises you can't keep, or a whole bunch of things which could lead to bankruptcy. The value of your house falling, and you're not paying back your home mortgage loan. What are the consequences when you quote declare bankruptcy? I think some of us have an impression it's a do-over. You just get a clean slate, you get to start over, and too bad for the lenders. Is that true? How has it changed over time? Because I know there have been some revisions in the law recently. So how has our treatment in America of bankruptcy changed? What's the whole idea of it? Is it a good thing, bad thing?
In general, to some extent, the idea that it's a do-over is kind of accurate. What you have to understand, though, is that there's two types of credit or two types of debt, and bankruptcy impacts them in very different ways. One type of debt is what we call secured debt. That is your house, a car loan.
There's collateral.
Something like there's collateral, right? If you don't pay the loan, the lender can come and repossess the car or foreclose on the house. Bankruptcy doesn't help you very much with respect to that, because even if you were able to discharge your mortgage debt, the lender would still be allowed to come and take your house. So as the law stands right now with respect to your house or your car or that sort of thing, bankruptcy will allow you to stop the repo man, but it won't allow you a do-over with respect to your car loan.
I'm sorry, I'm confused. Let's explain again. Let's say I buy a house, I borrowed the money to pay the house, and I can't make the payments anymore, and I declare bankruptcy.
Right.
What happens to me? I lose my house.
If you don't make your payments, you lose your house.
Eventually. It may take a while.
Right. And so what bankruptcy will do will be to slow down the process and give you an opportunity to try to get your act together. There are some strategies you have in bankruptcy to try to cure the situation, but in the end, you have to pay the full amount. As the law stands right now, you have to pay the full amount at the contracted for interest rate in order to keep your house. And that kind of goes along with the idea that it's secured debt. And of course, in exchange for giving collateral, you get a lower interest rate on the front end.
For the people who keep their deal. But let's say I lose my house. I can't make my payments. I lose my house. The bank takes it. I still owe the money to the bank, but that is what is wiped out, I assume, by a bankruptcy proceeding.
Exactly.
Or does it vary by state?
You can wipe that out, exactly. And so the do-over amount applies to what we call unsecured debt, which is something like credit card debt is the most typical one. Medical debts are unsecured debts.
They don't come back and get the cure
because they don't exactly
antibiotics. Don't say I'm coming back for the pills.
That's right. And the difference there is that there is no collateral behind that. And basically, what bankruptcy does is gives you a fresh start and allows you, by and large, to wipe that out with some limitations. There's other debts that are unsecured debts, such as student loans. And it's always depressing for my students to tell them that even though student loans are unsecured debts, there are particular provisions in the bankruptcy code that says you can't wipe out your student loans, except in very, very limited conditions.
What does that mean? Let's say, let's take again all three cases. So we have secured loans like a house or a car. We have unsecured loans, which could be a credit card, but we have these unsecured loans like student loans that have a slightly different status, you're saying. So let's say I have all three. I've got a house, I've got student loans, and I've got credit cards. I lose my job. I can't make any of those payments. The envelopes keep piling up. I don't pay any of them, and I'm done. In the old days, I think you might tell me when this is. You go to jail, right? You made some promises, you didn't keep them. But what is the declaration of bankruptcy do for me that's different than just not paying?
You're right. In the old days, you did go to jail. And in the United States, up until the 1830s, a lot of states still had debtors' prisons because they thought of consumer debt as being a form of fraud. Interestingly, they treated consumers differently from businesses, which is that the idea that businesses could reorganize has a long history in law. But it was debtors' prisons for a long time. Throughout the 19th century, our de facto bankruptcy system was if your debts got too big, you just moved out to the frontier and just ditched your creditors, right? And that was essentially our bankruptcy system. Obviously, that won't work in a modern society. So what we have as a trade-off now is we have a central goal of the fresh start. And for a long time, even today, after including the fact that bankruptcy laws were tightened a few years ago, the United States has by far the most generous bankruptcy system in the world or in the history of the world, as far as we can tell, in terms of the fresh start. Why is that? Basically, I think it reflects our ethos as a place of second chances. A lot of people who moved here were running from creditors back in Europe. It reflects our spirit of entrepreneurship and risk taking. That we want people to take risks, even if it results in failure. And it also just reflects, I think, in some sense, just our charitable nature. That we're we forgive people who make mistakes.
Well, that's nice, except that the consequence of that, I'm not going to weigh in on that, but the easier you make it to walk away from your debt, the harder it is to get credit. So the more cautious, it's a, I think it was an application of the Coase theorem. Right? You punish the imprudent borrower, then people are much more eager to lend credit because they can count on that punishment to deter fraud or bad luck or encourage caution. If you reward the borrower or don't punish the borrower, there's less deterrence. The lender knows that, and that presumably is going to change the terms of the deal up front, right? But let's first just to get to the logistics, because I don't understand them. So I've got the house, I've got my credit card balance, and I've got my student loan, and I lose my job. And the envelopes keep showing up. What if I don't pay? Period. What happens?
The short answer is you lose the house, you walk away from the credit card debt, and you are forced to pay off the student loans with your money after bankruptcy.
I mean, once I get a job down the road.
Once you get a job down the road, right? And and basically what it is the student loan debt is said to be non-dischargeable, which it means that they can come after you for your post-bankruptcy earnings.
And they put a lien on my earnings?
They could put a lien on your earnings. They could garnish your earnings. They can do anything.
Explain what those are, by the way. What's a lien and garnish?
Basically, it allows them to go out and seize your bank account, or in some situations, they can intercept tax return refunds. All these different sorts of things. They can basically take matters into their own hand. And the idea is that for most debt, bankruptcy creates sort of a cleavage in time. It's almost as if you kind of die and are reborn as a new person. That's the idea of credit card debt being discharged, which is, pre-bankruptcy, Russ Roberts, disappears, and post-bankruptcy, Russ Roberts II emerges from the ashes without any credit card debt. If you want to keep your house, though, you have to pay your loan, and there are some debts where you jump the gap. Now, why is that? Well, as I was saying earlier,
jump
the gap between pre-bankruptcy Russ Roberts and post-bankruptcy Russ Roberts. Why do we have those rules? Well, basically the idea is, you were suggesting it earlier, the fresh start, as I was mentioning earlier, is an idea that's very deeply rooted in the American economic system and the American psyche. This idea of a discharge for people that's really somewhat unique in the world. But we balance that against other social goals. So, for instance, our view is that if you have borrowed money, especially government-backed, government-insured student loans, and you go to law school or you go to college or you go to medical school, and you should be able to get a good job, you have to pay that off. That's up to you to pay and not the taxpayers. So we basically say, we're not going to allow you to rack up $200,000 in student loans to go to medical school and then file bankruptcy and walk away from it. And so the whole system of bankruptcy then is a balance between this desire to further the fresh start on one hand, but make sure that people are not abusing or taking advantage of the system on the other hand.
But if I walk away from my credit card loan, what are the consequences?
You're
at the fresh start, meaning if I do get a job down the road, I'm not liable for those balances if I've declared bankruptcy. Is there any consequence?
You'll take a big old hit on your credit score, obviously. But the main consequence...
It's going to be harder to borrow money in the future.
It's going to be harder for you to borrow money in the future.
So when you say the gap in time, the cleavage in time, the new Russ Roberts unfortunately carries with him his... I want to make sure that I got
the ghost
that right.
of old Russ Roberts.
Good. Okay.
You don't have the credit card debt, but you still have...
the memory of it.
The memory of it.
In the system. Okay. Right. Just want to make sure I got that straight.
But the main cost is the one you suggested earlier, which is the more generous you make the fresh start, the more generous you make the bankruptcy system, the more susceptible to fraud and abuse you make the system, the more everybody else has to pay for it. If that's not a risk that can be tailored to a particular borrower, and usually it's not, everybody pays more. So a more generous bankruptcy system, I'll give you an example. There was a study done of, an analysis done of Memphis, Tennessee, which has traditionally been the bankruptcy capital of America.
Really?
Yes.
I was born in Memphis. You don't know that, but who knew?
Who knew? And it's for a variety of reasons that we could go into, but it's sort of a unique sort of place. But about 4 or 5% of the residents of Memphis file bankruptcy every year.
And that's a high number.
That's a high number, right. 4 to 5% of the population file bankruptcy. Now, what are the implications of that in Memphis? Well, in Memphis, they won't take an out-of-state check, basically, in most places, because they're afraid you're going to bounce a check. If you want to buy a used car in Memphis, the down payment on a used car is the wholesale price of the car. Why? Because they're afraid that if they extend you credit, you're going to be so likely to file bankruptcy that they won't even be able to recover the price that they paid for the car. So they
reclaiming collateral is expensive. It's
right,
not cheap.
Exactly, right. And so there's a whole there's a whole host of factors that if you increase the protection for people after the fact, you make it more expensive and more risky to lend to them before the fact. Yeah. And there's economic theory tells you that, and there are decades of empirical studies that support that. There's always some price. There's never a free lunch when it comes to these factors.
So how has bankruptcy law changed? It was recently revised in 2005. What was the political impetus for that change, and what direction did we go?
The political impetus for that change was we had a major overhaul of the bankruptcy system in 1978. The response to that was that...
Why? And what did we do?
In 1978, we substantially loosened our bankruptcy laws. That sort of the onset of the modern consumer credit economy, which really arose in the 1950s and 60s, as people moved out to the suburbs and bought new houses and bought furniture and bought cars, and sort of the 1950s and 60s is really the threshold time, the key time in American society where consumers started using credit in a very major sort of way. They looked at that and said, we need to modernize the bankruptcy system. And the idea was they would substantially loosen the bankruptcy system for consumers to get access to it. The result was that beginning in 1980, there were about...
Declaring bankruptcy cheaper and easier.
Exactly, right, because they were concerned, so many more people had so much more credit, which was true than it was in the past, and more people were going to get in trouble, and they needed a helping hand out, right, help up. A lot of people were no longer self-reliant, right? This was the agricultural economy, really it shrunk a lot during this period. So you didn't have as many people who were sort of self-reliant and that sort of thing as well. So they thought we needed a more modern bankruptcy system that was more borrower-friendly. The result was that in 1980, we had about 250,000 bankruptcies every year. Personal bankruptcies. And by 2005, we had about 1.5 million bankruptcies a year. And so what we saw was during the 1980s and 1990s, really the greatest period of prosperity in American history. Low inflation, low unemployment rates, increases, steady, sustainable increases throughout most of that period in the stock market, in the housing market. Everything pointed to Americans being more prosperous than ever, yet the bankruptcy filing rate quintupled during that period. The other thing we saw was experience told us that...
It quintupled, but it wasn't very high. It's important to remember.
Right.
Quintupling sounds, oh my gosh.
Right.
But what was the raw number again?
It went from 250,000 a year to about 1.5 million a year.
Okay.
So it was getting to be a pretty big number. Or at least the concern was, basically the concern
wasn't good.
Yeah, the trend wasn't good, and the trend didn't seem to fit with economic reality, which is you would expect bankruptcies to rise when the economy goes bad. And in fact, what we've seen over the past year or two is the economy's gone bad, bankruptcies have started to rise again. So basically Congress looked around and they said, we want to preserve bankruptcy relief for those who need it, but we're concerned that bankruptcy has too often become a mechanism for fraud and abuse for people, that they were gaming the system. So they tightened up the laws, and basically what they did was they put new restrictions and new accountability built into the system. So a lot of things were just very simple things.
This was when?
2005.
So 78, we had a loosening. We saw then a period of increased bankruptcy.
Right.
Congress reacted in 2005 with the tightening. What were the provisions that were tightened?
And the way to think about it, again, is what we were talking about earlier, right? We want to help people, but we don't want to make it a system of fraud and abuse, because we all pay. If there's people who are walking away from debt that they could pay, the rest of us pick up the debt, pick up the bill for that. So what they did in 2005 were a couple things. Some of them were just very common sense sorts of things. They started making you file tax returns when you filed your bankruptcy, what they call schedules. It used to be almost completely on the honor system. And what we knew was a lot of people were just not telling the truth about how much money they had. Their capability of repaying. Put the money in a shoebox under the bed and just don't tell the court. Nobody will know about it. People were saying that they didn't have bank accounts, even though they made $70,000 or $80,000 a year. And so a lot of it was just to put some accountability in the system. One of the other big innovations was to require those who make above their state median income, adjusted for family size, who could repay a substantial portion of their debt in bankruptcy, are now required to do so. Basically, means testing. Now,
so not a full do-over.
Not a full do-over, right? A limited do-over. And what they would be required to do, there's two ways of filing bankruptcy. One is the full do-over, what we call Chapter 7 bankruptcy. The other is Chapter 13, where you enter into a repayment plan going forward. Traditionally, the reason you file Chapter 7 versus Chapter 13 is Chapter 7 is the do-over. Take all your property and take all your debt, put them in a bucket, basically, and give it out to your creditors, and
There's not enough to go around. Too bad for them.
Too bad for them, right. And so the way you can think of it is it was a mechanism for protecting your future income, but not your wealth. In practice, you could protect a lot of your wealth because of the way in which the laws work, but that's the basic idea. Chapter 13 was a system that would allow you to protect your wealth, but not your income. So you wouldn't have to give up any of your property. You just have to agree.
As long as you were covering your mortgage.
Exactly, right. Exactly, right. And they would make an allowance for that.
Or if you owned it outright.
Right, exactly. So that you wouldn't be required to give up your. So in Chapter 7, for instance, if you own your car outright, you might have to give up your car.
To pay off a fraction of your.
Exactly, right. Where in Chapter 13, if you own your car outright, you get to keep it. In exchange, what you'd have to do is give up some of your future income to repay your creditors. But what we found out was that because of the way the system worked, a lot of high-income people could go into Chapter 7 and because of the way what we call property exemption rules operate, could get out of basically having to repay anything. So one of the things the bill does,
2005 bill.
The 2005 bill did was push people who have high income to dedicate a portion of their income to repaying their debt, because it was believed that a lot of high-income people, or at least a substantial number of high-income people, were walking away from debts that they could have repaid.
And so, as a result, in 2005 or 2006, before the housing market collapsed, I assume bankruptcies fell from that 1.5 number down.
Well, it's actually sort of an interesting story about the extent to which consumers respond to incentives, which it was about 1.5 million. Then in 2005, the filing numbers all of a sudden, when the bill was enacted in April, but didn't go into effect until October. So off that 1.5 million filings base, it went into effect on October 17th, 2005. The 2-week period preceding October 17th, 2005, 500,000 people filed bankruptcy
under the terms of the
old regime.
Yeah.
And the week before it went into effect, 350,000 people filed bankruptcy under the old scheme before the laws got tightened. And then it dropped from 2 million then, because you added 500,000 to the 1.5 million, dropped to 650,000 in 2006, about 800,000 in 2007, a substantial drop, even if you account for people who may have pre-filed. And in 2008, it looks like it's about a
drop
million.
Relative to the peak.
A drop relative to the peak, right. And so, and last year was about 1 million. And so what we're seeing, and I think one of the reasons why I think, although there were some problems, we can think of bankruptcy reform as a success, at least in terms of what they hope to accomplish, is bankruptcies are rising now again. But we would expect bankruptcies to rise. We want bankruptcy. We've made a decision that we want bankruptcy for those who are in trouble. And now as the economy's gone south, bankruptcies will rise again. But we're not having that sort of anomaly that we had in the 80s and 90s where bankruptcies were skyrocketing even as the economy was booming. So I think we struck a new balance between the fresh start and sort of responsibility and limitations on it. And so far it seems to be working.
My only quibble with your analysis there is the phrase, "we've made a decision," in that I try to stay away from that kind of language. There's really no "we" there, and there's no decision.
It's sloppy
but the
language.
political process has a decision has emerged from the political process with changing the mix between those things.
Exactly. Yes, that's a very good caveat. The bill itself was passed with about 75% in both the House and Senate. All Republicans voted for it, and all centrist Democrats voted for it. The only ones who opposed it, were sort of liberal Democrats, from which I take away. Yeah, I mean, it was, they people, by and large, they were voting, I think, in a way that reflected the views of the country, which is, in some sense, they're balancing sort of responsibility against the fresh start, and it was an ideological decision.
That's a very
because
interesting
it's an art, not a science. Yeah. It's an art, not a science, to think how we want to balance those competing goals.
Yeah. I think the public choice side would be interesting. I don't know if you've looked at that at all. I assume you've really framed most of this discussion so far as a sort of a benevolent dictator who would try to trade those off. I assume there were some special interest influences there, either in the old regime and the revision, but we'll maybe say that for another time.
Well, can I just say the public choice factors are fascinating. And I've learned a lot about it. And in the book I'm writing on this, I've got a whole chapter dedicated to this. Basically, the way to think of it is bankruptcy lawyers have a vested interest in having more bankruptcies. And so they've always pushed for looser laws. Creditors have
more complicated laws.
More complicated laws, right. They want bankruptcies to be more plentiful and more expensive.
Yeah.
Creditors want to have less expensive and fewer bankruptcies. And so basically they push and pull against each other. And over the broad expanse of American history, it crudely put, in the long run, they kind of balance each other out. And what the driving force seems to be within at least the center of gravity in Congress tends to be sort of ideological, which is in the years the Democrats controlled Congress, there was sort of an ideology of favoring debtors And when Republicans came into Congress in 1994, they drew back from some of that. So this is, I think, the way to think of bankruptcy reform is of a piece with welfare reform, which is an effort to try, a different governing coalition with striking a different balance.
Let's turn to the mortgage market. We've talked on the show about the subprime mortgage problem, and most of the time we've talked about the foreclosure rate rising because of negative equity. That basically, when you bought a house with no money down, and when the price of the house fell unexpectedly, or, as we mentioned in passing a minute ago, if you bought a house with some equity because you put money down, but you borrowed against the equity which eliminated it, and then the price went down, that it's rational to walk away from your house in that setting because you're investing in something that has a negative rate of return, essentially, by continuing to make your payments. Now, it's immoral to walk away from your house in the sense that you made a promise to repay the loan, and I assume there might be some conscience issues there. And I assume there are also this bankruptcy plays a role as well, that there could be consequences or lack of consequences if you walk away. But is that what's fundamentally going on as the default rate rises, that people it's no longer in their self-interest to keep their mortgage payments up?
I think when push comes to shove, that is that's the root of the foreclosure crisis. It's a little more complicated than that. So let me just say a few words about that. But I think that gets to the nub of the issue, which is foreclosure can result from three different factors. The first is just macroeconomic conditions. So the reason why we have a horrific foreclosure rate in Detroit, more than anything else, is simply there's no jobs in Detroit. And in Ohio and Indiana. These places started turning down and getting into trouble well before a lot of this subprime stuff hit the fan. We know historically when hurricane comes through, foreclosures are left in its wake. And so I think that's part of it, but only in just local areas. And the foreclosures started rising and the real estate problems started rising well before the economy in general went down. So I don't think that can explain really what we're seeing. So there's really then only two other factors that can explain it. One would be distress caused by changes in interest rates, adjustable rate mortgages and that sort of thing. Now, what we know is that does seem to be a bit of a factor. And one thing that's not generally known is that adjustable rate mortgages are not a creation of subprime lending. In 1984, 61% of the mortgages written in the United States that year were adjustable rate mortgages. In 1988, it was in 50% or 56%. What we see is that over time, when the spread between short-term interest rates and long-term interest rates gets wider, so that the interest rate on an adjustable rate mortgage gets much lower than the interest rate on a fixed rate mortgage, consumers flip over and they start using adjustable rate mortgages more until that gap closes. So why didn't that cause a crisis in the past? Well, the primary reason is that in the 80s and 90s...
a crisis in the past because when interest rates climb back up?
Right. Well, in the past... the fact that there were a lot of in the past, the fact that there were a lot of adjustable rate mortgages kicking around out there, but they didn't seem to cause a huge foreclosure crisis like we have now.
And important to mention, those adjustable rate mortgages start off with a teaser rate usually that was low to start with, then they would adjust upward, but they would still be relatively low. They would rise toward and then be at roughly maybe equal to a longer-term interest rate, but that wouldn't normally cause a problem. People would anticipate that.
Right. And the teaser rate phenomenon seems to have been overstated. Most of the empirical evidence indicates, all the studies have been done on this, is that most of the loans that defaulted on teaser rates defaulted in the first 12 months. Before there was any reset. They were just badly underwritten loans.
But if interest rates are rising,
but if interest rates are rising, and what we're seeing that's disturbing is a huge difference in the foreclosure rates, not just between prime and subprime, but more importantly now, at least in my view, is between adjustable rate and fixed rate, which is that adjustable rate prime mortgages are going into foreclosure at a rapidly increasing rate. And so does seem to be some factor that adjustable rates, whether prime or subprime, is a risk factor. Why has that turned out to be a problem now and it wasn't in the past? Well, I think in the past what it was the adjustable rate mortgages were, by being lower, were basically leading down fixed rate mortgages, right? So there was a long secular trend in the 80s and 90s of lower interest rates. The problem that happened this time around was from 2000 to 04, adjustable rate mortgages were pushed down so artificially low by Federal Reserve monetary policy that rather than fixed rate mortgages coming down to adjustable rate mortgages went up to where fixed rate mortgages were. And so I think some people got caught in that whiplash. And what we see is it's affecting prime as well as subprime borrowers.
But why do you need that? It would seem to me that the real problem is the declining price of houses. I buy a house with 20% down, and it goes down by 10%, which would be an unusual event in our lifetime in most markets.
Right.
I still have 10% equity. I buy a house with 5% down, and it goes down by 10%, which, although it's unusual in our lifetime, is not unusual in the last 2 years. And as a result, I have negative equity, prime or subprime. And it seems to me, and this is what I want you to tell me, it seems to me that the only thing that keeps a prime customer in that negative equity house is the stigma and future costs of bankruptcy. Right?
Exactly right.
But others are saying, well, there may be some stigma, there may be some costs, but if my house has gone down 25%, and I had 5% equity, I might just walk away.
And to start with your first question is, why does it matter? It matters because there do seem to be some people out there who want to keep their houses, but their interest rates have gone up as interest rates have gone up. Now, that it may be that alone is not enough of a problem. It may be that you have to have the second factor, right? Which is that if your interest rate has gone up and you can't make the payments anymore, if you had positive equity, you could sell the house.
Or you try harder to make the payments.
Or try harder to make the payments or refinance, right? And so, and that's exactly what people did. What you're pointing to is the idea of negative equity. And the way we can think of this, related to what we were just saying, is you could think of it as your house as an option. It's being like a financial option. It is a call option in the sense that if it goes up in value, you can, if you can't make the payments, you can sell or refinance, right? And that's what a lot of people did when house prices are rising. When it goes down an option, you could think of it as a put option to give it back to the bank, and walk away. What economic theory tells us is that that if the value of exercising that option goes up or the cost of exercising it goes down, you become more likely to exercise the option. So, to give an example, several states, about 8, have what are called anti-deficiency laws or non-recourse laws. And in those handful of states, California and Arizona being 2 big ones, if you walk away from your mortgage, the remedies of the bank, what the bank's allowed to do is to take back your house. But they're not allowed to sue you for anything more that you might own. No
matter how wealthy I am.
No matter how wealthy you are. That's part of the state law. So if you bought a house for $400,000 and it goes down to $300,000 and you live in California and you walk away, all they can do is take back the house, sell for $300,000, and that anti-deficiency law is basically like a get-out-of-jail-free card.
That's the do-over thing.
Yeah, that's the do-over thing. And what we know from economic studies is that the estimate is that when house prices fall, people in an area with an anti-deficiency law are 2 to 3 times more likely to walk away from their house than they would be if the lender was allowed to come after them for that additional $100,000.
So you try harder.
So you try harder.
To keep your payments going.
Now, I would disagree in some sense, or I won't disagree, but you said that it's immoral, and certainly it is immoral in some sense to not keep your contract. But I think Another way to think of it is just what is rational behavior. And it reminds me of a conversation I had with my wife recently where I was talking about this and people walking away from their homes when they're underwater. And she says, "Oh, that's ridiculous. We would never do that. We would never just get rid of our house, right? Because, we're committed to it. It's wrong,
we
right?"
made a deal.
And I said, what if somebody walked up and knocked on our door today and offered us $3 million for our house? Would we walk away from our house then? Right? And the answer is yes, right? So, in some sense, if you just think of people as being rational, that thinking of it as a call option and a put option.
I don't see the analogy.
You don't see the analogy
to the morality issue, but I do
Right.
do take your point
Right.
that I think people respond rationally to the incentives. But I want to make sure I understood the previous conversation about bankruptcy law.
Right.
The non-recourse, what's it called, deficiency?
Anti-deficiency.
Anti-deficiency clause, which is in 8 states.
Right.
That means in the other 42 and a bit, depending on what you call a state, the rest of the country, if I walk away from my mortgage and I borrowed $400,000, let's say with no money down.
Yep.
It was a $400,000 house. I borrowed $400,000. The price goes down to $300,000, as you say. The market value is perceived. I don't literally know that, but I perceive my house is suddenly only worth $300,000, and I stop making the payments in one of those other 42 states. I eventually have to pay back that $100,000
if the bank decides to sue you. And often, and so it's a threat. Basically, the banks have the threat of suing you for the additional $100,000.
In the workout, meaning if there's a negotiation about my situation, either because I've lost my job. Or I could just say I don't feel like paying. Right. I might try to get my mortgage written down a bit.
Exactly. So the bank might say, one of the problems we have now is people trashing their houses when they go into foreclosure. And the bank might say, let's cut a deal. Rather than forcing us to bring a foreclosure action against you, and driving you into bankruptcy or something like that, and you getting upset and trashing the house, let's just cut a deal. You give the keys back to us, and we let you walk, right?
So trashing the house is the flip side of the anti-deficiency, right?
That's right. That's right.
The bank says I'm threatening you with
foreclosure,
foreclosure, and you're gonna owe me $100,000 down the road.
Right.
My counter response is then I'm going to gouge out the woodwork and crack the driveway.
And I'll make you jump through all the hoops and take 6 months to do it. Meantime, I'm not going to spend any money on the upkeep. I'm not going to mow the lawn. And so there is sort of, a back and forth that goes on there. The other thing is as you alluded to, it's not just that the house goes down in price now. What seems to be driving it is the expectations of when the house is going to go up in value. And so one of the real problems we have now is certain areas of the country seem to have become overbuilt in terms of supply and demand. Yep. A lot of these sort of ring suburbs around Las Vegas, out here in Loudoun County, we've got horrifically high foreclosure rates. In Virginia, right. We've got horrifically high foreclosure rates, which I think reflect the fact that people who have houses, they're underwater, and they have no expectation that they're going to come back into the money anytime soon.
Might be a very, very
right,
long
and
time.
So they're walking away.
Last question. We're almost out of time. The innovations in the mortgage market of mortgage-backed securities and collateralized mortgage obligations had a big benefit, which you've recognized in some of your work, and we used to recognize more often when the costs that weren't there. But the benefit was a lot of people got to buy a house, got access to credit that they normally historically would not have had access to. One of the problems, it seems, with that, although I don't think this gets enough attention, you see it alluded to occasionally, is that it has changed the ability to do these workouts. That is, in a situation where someone really does fall on hard times, either because of macro effects, regional factors, bad luck, whatever it is individually, people in the past would go to their mortgage issuer and say, look, I know I owe you this money. I'm hopeful I'll find a job in the next 6 months. Can you help me out in the meanwhile? And I hope to get back on my feet and keep my end of the deal. When these have been split up, bundled and tranched and sliced and diced, it appears that the ability, say it differently, the originator, Countrywide, for example, then resold the mortgage to a Swiss pension fund with 2,000 other mortgages in this bundle, there's no owner of the stream, individual owner of the stream of payments. You're bundled with all these other people, and the transaction costs there of working it out are basically infinite. Is that true? Is that a problem?
That does seem to be a problem, from what I can tell. That when these products, these mortgage-backed securities were created, they just never really anticipated they're going to be working out a lot of foreclosures. They had some sense, I think, of what the foreclosure rate was going to be, and they would just, deal with it. But they weren't going to be engaged in ongoing negotiation with borrowers and that sort of thing. So I think it's something they just didn't really think about. That's one of the costs of this. You mentioned the benefits also, and I hope one of the things that comes out of this is that people do remember that there were benefits. There are benefits from this innovation. And one of the things we've seen in American history, to come full circle from where we started, is almost every single consumer credit device that has ever been introduced has gone through a boom and bust cycle, whether it was the initial credit cards that were sent out in the 1960s, where Bank of America just dropped credit cards in the mail to people.
Yeah, get them started.
And they misused it. Whether it was subprime auto lending in the 1990s, which had a complete catastrophe and now has stabilized. Basically, we seem to go through an initial boom and bust phase, but these innovations seem to end up staying with us if we allow them, and we get rid of the excesses and oftentimes keep the core value that are in these in the products. And so we should keep that in mind, that we don't want to overreact too much here, because all these problems are going to be self-solving. A lot of investors lost a lot of money, and they're not idiots. They're going to learn from that. And so we've learned a lot of very expensive lessons, but let's keep in mind we have learned lessons about where the problems lie.
My guest today has been Todd Zywicki of the George Mason University School of Law. Todd, thanks for being part of EconTalk.
Thanks.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.